Accounting principles. These are the fundamental guidelines that shape everything we do in finance and accounting. Understanding these principles is key to making sound financial decisions and communicating effectively with others in the field. Today, I'll walk you through 7 core accounting principles: conservatism, consistency, full disclosure, going concern, matching, materiality, and objectivity. Mastering these concepts will empower you to approach finance with confidence. Let's start with conservatism, also known as prudence. The key idea here is better safe than sorry. According to this principle, we record all anticipated losses as soon as they are likely to happen, but we only recognize profits once they are actually earned. Imagine you've made 2 payments to a supplier, but the bank has returned them with account unknown messages. You can't reach the supplier, so should you record this as a gain? No, not yet. The conservatism principle tells us to keep the liability on the books until the situation is resolved. Next, we have the consistency principle. This principle emphasizes maintaining a stable approach to financial reporting. For instance, if you depreciate assets using a straight-line method one year, you should continue using it unless there's a strong reason to change. If you switch to mileage-based depreciation for vehicles in the second year, you can't revert to the straight-line method in the third year just because the new method results in higher depreciation. Consistency ensures your financial statements remain comparable year over year. Full disclosure is about transparency. This principle requires that all relevant financial information be presented truthfully and completely. If your company is facing multiple lawsuits over product quality, even if your legal team believes these suits are baseless, you must still disclose them in your financial reports. Users of financial information need the full picture, and that's where full disclosure comes in. The going concern principle asks, is this company financially stable enough to continue operating into the foreseeable future? If a major client goes bankrupt, or if there's doubt about whether you'll be paid, it might be time to question if your business is truly a going concern. If your largest customer files for bankruptcy and it's unclear if another customer of that size can be found, you should disclose this uncertainty in your financial statements. With the matching principle, it's all about timing. This principle ensures that revenues and related expenses are recorded in the same reporting period. Let's say you pay upfront for a 2-year maintenance contract. Instead of recording the full expense immediately, the matching principle requires you to spread it out over the contract's duration, recognizing 1/24 each month. Materiality is one of my personal favorites. It acknowledges that while mistakes can happen, not all are equally significant. Materiality defines the threshold at which a mistake affects the fair representation of financial statements. If $10,000 is misclassified as cost of goods sold instead of selling, general and administrative expenses, the materiality of this error depends on your company's size. For a small company, it could be significant, while for a large corporation, it might not be. Finally, we have the objectivity principle. This principle emphasizes that accounting should be based on verifiable facts, not subjective opinions. If a machine in your factory hasn't been used for 3 years but is still valued on the books, the plant manager might insist it's still useful. However, without a solid business plan to back up this claim, you might need to consider writing it off or recording an impairment. Want to dive deeper into finance, accounting, and investing? Subscribe to the GNO Finance channel and start exploring the recommended videos on your screen. Thanks for watching, and I'll see you in the next video.